We are fast approaching the 2-year anniversary of one of the darkest days in modern history, September 15th, 2008, the day that Lehman Brothers failed, nearly causing a massive meltdown in global financial markets. And yet, it's only now that Congress has finally gotten around to delivering regulatory reforms designed to prevent the next meltdown. Are the reforms enough? Will they prevent an even darker day in the future? Today, Martin Weiss, president of Weiss Ratings, is here with me to explore that question.
And the answer, David, is no. Regulatory reform, as it's currently framed, will do little or nothing to stop another meltdown. I count 3 fundamental forces that drove us to a meltdown, and I see nothing in the reform legislation that will change the direction of those forces.
I assume one of these forces is related to the banks?
Yes, and despite the reform, the big banks continue to use consumer deposits for high-stakes speculation with derivatives. Bank of America and Citigroup are exposed to the tune of more than 150% of their capital. JP Morgan Chase, 265%. Goldman Sachs, 766%.
But isn't regulatory reform going to fix this problem?
No, the banks are still going to be trading risky derivatives, and they're still going to be using your deposits to do so. Here's the bigger problem. Despite some reforms of commercial banks, we see no reforms whatsoever of central banks. And yet, ironically, central banks, especially Alan Greenspan's Federal Reserve, are the ones that were largely responsible for causing the debt crisis. Greenspan forced interest rates down so low and poured so much cheap money into the economy, it should come as no surprise that he created a massive bubble, which caused the debt crisis. But there's nothing in the bill that reforms the Fed or prevents it from creating still another bubble. And now, Ben Bernanke is doing far more to pump cheap money into the economy than Greenspan ever did. Here's the third problem. The reform does nothing to restrain the U.S. government, the biggest borrower and spender of all.
It's ironic that Congress is trying to reform the finances of major banks, but is doing nothing to reform its own finances.
It is the largest governments in the world who now own the bad debts left over from the previous crisis. And it's the largest governments of the world that are likely to be at the center of the next debt crisis.
Thank you, Martin. Coming up, we'll find out how. From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. After months of negotiations, lawmakers have finally cobbled together a plan for financial reform. Now, there's no guarantee that the legislation, as it's currently framed, is actually going to become law. But even if it does, many experts say it won't solve the underlying problems in our banking system. Joining us with his thoughts on the reform bill and the financial industry as a whole is Weiss research analyst Mike Larson. Mike, what is your sense of what this bill could accomplish?
Sure. Well, Jamie, broadly speaking, the reforms are designed to do 3 things. Number 1, strengthen oversight. Number 2, reduce risk by restricting what's called proprietary trading by the FDIC-backed banks. And number 3, it's designed to change the way that derivatives are created, bought, and sold. But frankly, these solutions don't get to the heart of the problem, which is the lack of enforcement of the rules on the books.
And you think, I'm assuming, that's going to continue, right?
Well, just look at recent history. Nobody in a position to crack down on dangerous practices has either been willing or able to take a stand.
Okay, if we get some of these new rules on the books, though, wouldn't that help regulators actually do their jobs?
Well, maybe, but again, what's more important than the law is backbone. You need somebody who's in charge that's willing to do the job no matter what kind of backlash he's going to get from Wall Street or Capitol Hill or the White House.
And who is that?
Well, Paul Volcker might be an option. Mr. Volcker was the Federal Reserve Chairman long before Alan Greenspan, and he's now an advisor to President Obama. Now, back in the early 1980s, in the midst of runaway inflation, Volcker raised interest rates several times, even though everyone hated him for it. It was tough medicine, especially because the economy was struggling so badly at the time, but it was exactly what the country needed. Now, I'm not saying it has to be Volcker this time, but but we have to find someone with that same type of courage to do what's right, no matter the consequences.
Well, let's talk about what you're seeing right now in the overall economy and specifically the banking sector.
Sure. Well, I think that up until now, the government's been propping up the housing market and the banks with free money and some accounting gimmicks. So from a stock market perspective, you didn't want to be shorting those companies that were being backstopped by the government. We also did have some improvement in the economy and some improvement in credit quality, and that helped the bank stocks over the past year. But now I think the economy is rolling over again, and I think we're definitely heading into what's called a double dip recession.
What does that mean for the banks?
Well, in a double dip scenario, credit quality, which had been improving when the government was propping up the economy, is going to take a turn for the worse. And if the job market doesn't pick up, which it doesn't seem to be doing, you're going to see more early stage delinquencies and defaults, not just on home mortgages, but on credit cards and commercial loans as well. And obviously, that's terrible news for the banking sector.
Mike, it sounds like you're advising investors here to stay away from financial stocks entirely.
Well, in my portfolios, I've been neutral on the banks for a number of months, but I'm starting to see signs that indicate it's about time to get aggressively bearish on the banking sector again. In my Safe Money report, I've been recommending that investors lower their overall exposure and begin targeting vulnerable sectors, including financials, with inverse ETFs.
Well, we're going to be talking to ETF expert Ron Rowland in just a few minutes. He's got some specific picks for us. Are you also looking to short individual banks?
Well, yes, investors can either short these stocks or use put options to take advantage of another banking crisis. In the Crisis Opportunity Speculator Service, I'm giving investors specific guidance on exactly how to do that.
Mike, any safe plays in the banking sector right now?
Well, there always are going to be a few smaller names that will be relative outperformers, but I just think it's a good rule of thumb for investors that if you own bank stocks, sell. And that goes double certain for European banks. These banks are broadly exposed to government bonds and cross-border lending to countries like Greece and Spain, which are facing sovereign debt crises. So while I think all the big banks are vulnerable, many of the European lenders are especially so. They were kind of on the periphery of the previous banking crisis, which was driven by housing here, but Europe now is ground zero for this one.
All right, Mike Larson, thanks so much for being here.
Thank you.
So if ground zero is overseas, well, let's head to where the action is. Joining us from Berlin with a look at the European financial sector is Klaus Vogt, editor of the European Safe Money Report. Klaus, do you agree with Mike that financials are in big trouble right now?
Oh yes, Jamie, I do. Mike is exactly right that there is a huge wave of defaults coming in both Europe and the US. European banks have some major problems. The first being the unresolved mortgage debt on their books. Just as in the US, as the economy declines, credit quality gets worse and people are unable to pay their debts. I think that the European banks are in even bigger trouble because they have a problem that the US banks, for the most part, do not have. The sovereign debt issue. The bailout of Greece did not solve the problem, it just papered over it. And of course, many more countries have similar debt problems. But what many people don't understand is that this was not a bailout of Greece. It was a bailout of the banks of the European banking system, especially French banks like Société Générale and BNP Paribas. They are said to have the largest holdings of Greek government papers. So if Greece had been allowed to default on its debt, the two largest French banks and probably the whole French banking sector would likely have gone bust. And that is what the European Union could not allow to happen.
Klaus, why hasn't that been more widely reported by the media?
Oh, because we don't know for sure what is on the books of these European banks. Regulators are allowing them to hide their debts. One of the biggest problems during the US housing crisis was that banks were allowed to record the most toxic mortgages at face value, even though they were worth almost nothing. We are seeing the same problem now with European banks and sovereign debt. We have no way of knowing just how much trouble these institutions are in because they are not required to disclose their holdings.
Klaus, would you advise investors to bet against the European banks?
Well, your viewers will be the first to hear me say this, but I think the time has come again to short the financial sector. These sovereign debt problems are starting to snowball, so we may see banking stocks go into a slump fairly